Hi, welcome back to Joe Blogs. Stock markets around the world are continuing to crash. Monday, the 7th of April, is proving to be the third consecutive day where we're seeing falls of more than 5%. And in fact, in Hong Kong, where the index is now closed, it closed down more than 13% down. That is an absolute disaster. And the reason why stock markets are continuing to tumble is because Donald Trump isn't showing any signs of relenting on his reciprocal tariffs that were announced last week. In fact, in a recent interview that he gave on Air Force One, the US presidential jet, he said that this was actually good news for the USA.
Because of the tariffs, we have $7 trillion already committed to be invested in the United States, building auto plants, building chip companies, and all sorts of companies are coming into our country at levels that we've never seen before.
If you've been following the channel, you'll know that Thursday the 3rd and Friday the 4th of April were an absolute disaster for stock markets around the world, with more than $10 trillion wiped off share prices. And the reason why the stock markets are tumbling is because they look forward. They're looking at what's going to happen to companies in the future, and Donald Trump's tariffs that are applying tariffs on all imports coming into the USA mean that most companies are going to see a fall in their profitability. And also, there is now a major risk of a global recession. At the time of making this video, the FTSE 100 index, which are the 100 largest companies listed in London, was down by more than 5%, and that 5% fall is on top of the 6.8% fall that we saw on Thursday and Friday last week. The DAX index in Germany is down by more than 6.2% today, and that's on top of the 8% fall that was seen on Thursday and Friday last week. The CAC index in France is down by more than 6.3%, which is on top of the 7.8% fall last week. And the situation in Asia is actually much worse. The Nikkei 225 fell by more than 7.8%, which is in addition to the 5.6% fall seen last week. And as I mentioned at the start of today's video, the Hang Seng index in Hong Kong closed more than 13.2% down. So the big question here is, where is the bottom of this market? When is the crash going to stop? And I think the answer to that is nobody knows. And that's one of the reasons why I didn't change the statue in the background today. Normally I rotate them, but I think this falling man breaking his neck is a good comparison to what's happening in the stock markets right now, because what we have got is a situation here where markets are running for cover. Everybody is panicking because the implication of the reciprocal tariffs is going to be really devastating to lots and lots of businesses and industries, because Donald Trump has hit all imports really hard. And the USA is the biggest market in the world, so it's the world's largest importer. Interestingly, we heard Donald Trump saying before in his interview with Air Force One that he was saying that he wants the balance of trade to be equalized between the USA and China.
We have a $1 trillion trade deficit with China. Hundreds of billions of dollars a year we lose with China. And unless we solve that problem, I'm not going to make a deal.
He's saying that there's a trade deficit. The USA buys more from China than China buys from the USA. But I think the reason for that is because there is a huge difference in terms of what people are being paid and what money they have to spend. As you can see from this graphic, the average wage in the USA in 2024 was just under $68,000. However, in China, the US dollar equivalent of the average wage was $16,700. So people in the USA on average are being paid 4 times more than people in China. And when you take into account the cost of living, on average, Chinese people have around $5,700 of disposable income. So that's income after they've paid for all of their essentials, such as rent and heating and food, all of those sort of things. And when you think about what the USA is actually manufacturing and exporting, a lot of those goods are high value. They are things that have a lot of technology involved in them, and so they cost a lot of money. So it's unlikely that lots of people in China are going to be buying lots of American exports. So I don't think it's logical for China to be buying the same amount of things as the USA is buying from China, because China is a manufacturing country. We've talked about this before. The reason why China is making things and then selling them all across the world is because they have a low cost of labor. So things that are labor intensive, where you need a lot of people working on it, tend to be built in countries where it doesn't cost much to actually pay those people. So what this analysis shows shows us is that it's unlikely that the USA is ever going to be in a position where China is buying as much from it as the USA is buying from China. So I don't think Donald Trump's logic in terms of the trade deficit actually hangs together, because it's always going to be the case that the USA buys more from lower cost economies because it's cheaper to do so. Now, Donald Trump is trying to eradicate that. He's trying to stop the USA buying things from places like China and Vietnam and Taiwan. But the problem that will drive in the US economy is that prices will go up. And also, as we've discussed before, the USA isn't really ready to start making all of the things that are being produced in those low-cost economies. So one of the reasons why stock markets are continuing to fall this week is that last week, a lot of traders would have been saying, let's just calm down, let's wait for the dust to settle, let's wait for Donald Trump to come out and give an update on these tariffs, because it probably won't be as bad as we think it could be. However, today, everybody is now starting to think, actually, this could be much worse than we initially thought, because if these tariffs actually do come into place, this is going to blow all of the trade agreements that are in place around the world out of the water. And this could cause one of the biggest global recessions that we've seen in the last 50 years. One of the other reasons why stock markets are falling so rapidly at the moment is because of the involvement of hedge funds. Now, if you think back 50 years to the good old days when hedge funds didn't really exist, the people that were buying shares were investors. So basically, you would buy shares in a company, let's say it was Ford Motor Company, the car manufacturer. You'd buy shares because you thought, I like Ford, they're making great cars, I think they're a good long-term investment. So you might buy $1,000 worth of Ford shares. Now, if the Ford share price fell by 1 or 2 or even 3% in one day, you probably wouldn't decide that you're going to sell, because firstly, you're at work, you're busy, you're doing things, so you may have forgotten that you've invested in Ford. Or alternatively, you might just take the view that it's a long-term investment, so you're not really bothered whether the share price goes up and down on a daily or a weekly basis. You're just holding those shares because you think Ford is a good long-term bet. And for a lot of pension funds back in those days, that was how they operated as well. They would just invest into a variety of different companies and just leave those investments ticking along. However, hedge funds have come along, and what those guys are doing is trying to make money whether the stock market goes up or whether it goes down. Now, over the course of the past 2.5 years, we have seen an extended bull run on the market. And what that means is that shares have been going up and up and up. So overall, the hedge funds have been making money from shares rising. So what that means is that they've been putting bets onto shares continuing to go up. Now, one of the really clever ways that hedge funds are able to increase their returns for their investors is through the concept of leverage. So if we look at this graphic, you can see that the hedge fund in this example is sitting on $10 billion of capital that it's raised from its investors. But rather than just investing that $10 billion, that hedge fund can then borrow an additional $20 billion so that it's got a pool of capital of $30 billion. So if that hedge fund then takes positions in stock markets around the world of $30 billion and it goes up by 10%, then the hedge fund will have made $3 billion profit. Now, once it pays back the $20 billion that it's borrowed, that means that the $3 billion equates to a 30% return on the $10 billion of capital. So that's obviously a fantastic result, because the markets have only gone up by 10%, but you've made a 30% return. So you're beating the market by 3 times. So you look like a hero. And obviously from the hedge fund manager's point of view, they take a big slice of that $3 billion of profit. So that's why they're all driving Lamborghinis and living in huge mansions. So based on that example, you might think that leverage looks like a really exciting thing. And you might be thinking, why don't I get into that? Why don't I start leveraging up my position? But the problem with leverage is that it also operates in reverse. So if we take the same example where the hedge fund has $10 billion of its investor money, it borrows $20 billion and invests $30 billion into the markets. If the markets then fall by 10%, which they did at the end of last week, that hedge fund is then sitting on a $3 billion loss. And the problem that the hedge fund has is that the market makers who've made all of those positions for the hedge fund will then ask for $3 billion in cash to be placed to support the losses. That's called a margin call. However, in this example, the hedge fund doesn't actually have any cash because it's invested the full 30 billion, the 10 billion of its investor money and 20 billion that it borrowed into the markets. So the only way that it can raise $3 billion in cash to pay that margin call is by selling its investments. And when you get lots of hedge funds all in this same position at the same time, which is what's happening right now, we have a run on the market because these hedge funds are forced to sell their positions to realize the cash to cover their margins, to stop them being insolvent and actually facing bankruptcy. So they're forced to sell. But the problem when you have a lot of forced sellers is that it drives the price down and therefore triggers more margin calls. So basically, if we see another 5% fall in the market today, in this example, those hedge funds would then be asked for another $1.5 billion to cover the further falls. And so they'll have to sell more of their positions. That means there's more sellers in the market, driving down the price, and so it goes on. And this is one of the reasons why the leverage in the market and the hedge funds positions are accelerating the fall of the markets right now. So what's the summary and conclusion today? Well, I wanted to post this video because the third consecutive day of falls of around 5% in the markets is really quite worrying. What we are seeing here is a run on the market. This could be one of the biggest stock market disasters that we've seen in the history of the stock market. In a recent video, I talked about the 1929 stock market crash, where prices fell by 36% over the course of 3 days. Now, at the moment, we've only got a fall of around 15%, but that's on its way to being half of what we saw in the Wall Street crash back in the 1920s. If this continues for the rest of this week, there is a strong likelihood that we could see a 30% fall in the market in the space of 7 days. And if that happens, it's going to be an absolute disaster. And as we also discussed, the problem we've got right now is that there's a lot of leverage in the market. Hedge funds have been doing very well while the markets were going up. They were taking on lots of borrowing. They were taking out lots and lots of positions, expecting the market to carry on going up. The problem that they've now got is that as the markets start to tumble, they're being asked for cash. They're having these margin calls. That means that they are now forced sellers. And as we have a lot of forced sellers, prices are going down at a rapid rate. That's causing concern on top of the concerns about what's happening with Trump's tariffs and global recession. And so we've got a real mixture here of different factors that are driving down the markets. And the big question is, when is this crash going to come to an end? And I don't have an answer for you because as it stands right now, we could see continued crashes of 5% or more on a daily basis over the course of this week. So hopefully you've enjoyed today's episode. Maybe you didn't enjoy the content, but as I said, this guy here is really a good example of what's going on right now. This is breaking people's necks all around the world from a financial point of view. Hopefully you've enjoyed the explanation and a bit more detail as to what's going on. If you have liked what I've said, then please give me a thumbs up. Thank you so much to everyone that's supporting the channel. If you bought me a coffee or sent me a YouTube super thanks recently, thank you so much for that. Really means a lot to me. And if you're a long-term supporter, either through Patreon or YouTube membership or buy me a coffee membership, thank you for that long-term support. Really helps to keep me motivated. And here's something to put a smile on your face.